Hey, this is Chris from Financial Modeling Education, and in today's video, I'm going to talk about the number one issue I see with three-statement modeling and why they are prone to error. And that's typically using the statement of cash flows to reverse engineer the balance sheet. And I most commonly see it in the CapEx section here. And so what do I mean by that? Like reverse engineer the balance sheet. So what can happen often is a company knows, all right, we're going to spend, in this case, 197 of CapEx. We're going to be buying some new equipment. And so what somebody will do is they're going to punch in that number right here in the statement of cash flows, and then they're going to go up to the balance sheet and link to that number. They're just going to say, okay, well, our fixed assets is now going to be equal to the prior period plus the new CapEx amount, and they're going to link it down to their cash flow statement. And what that's going to do is actually set you up for a lot of error and potentially even some circularity. The correct way to do it is just use your statement of cash flows and reference the information that you already have in the income statement and balance sheet. You really shouldn't ever be punching anything in down here. All you're doing is linking to the income statement or taking changes over time from the balance sheet. So as an example, the change in the fixed assets, the CapEx, we're just going to take the previous period minus the current period minus the depreciation because we already have depreciation captured in the operating section here. You can see if I hit F2 on this and open it up, I'm just referencing items from the balance sheet as well as the income statement. Same with the accounts receivable here, just taking the difference between the periods, and then same with the equity, or this is the debt here. Same with the debt down here, just the difference between periods. And so your statement of cash flows can basically run on autopilot once you build it correctly. You don't want to be punching anything in here and then backing into your balance sheet. Instead, you want to build your income statement as part one, and then basically build your balance sheet as part two, and then the cash flow statement is simply the difference between those two things, and that is it. Then you can let it run on auto from there on out. So to summarize, the number one issue I see, people punching stuff into the cash flow statement and trying to reverse engineer the balance sheet. That's the wrong way to do it. Build the income statement, build the balance sheet, and then you can calculate your statement of cash flows automatically from there. So that's it for this one. Thanks so much for watching. I will see you in the next one.